Good morning, good afternoon, good evening, folks. As promised in the daily financial news this morning, we are bringing you some brand new content with some folks who I've interacted with over the past, but now we're going to be bringing you some value, both Dustin and Jonathan. How are you guys doing today?
Good. How are you guys doing?
Good.
Awesome. Well, why don't you guys introduce yourself first? Maybe Dustin, you go first. Jonathan, you go next. Then we'll get into this. Dustin, introduce yourself to one rental at a time.
My name's Dustin Rosenberg. I've been in the industry for about 10, 11 years now. And me and John both started Convoy Home Loans at the beginning of 2021.
Oh, very cool.
And my name is Jonathan Yu. I have maybe 8 years. I'm a little younger than Dustin in the industry, but obviously age, I think experience goes beyond age. So that's where I'm at right now. And I'm really happy to kind of have that put together.
Very, very, very cool, guys. Thank you for reaching out. I know we've crossed paths there in the Central Valley. So thank you for reaching out. I'd love to bring you to the channel. So first, launching a small business, 2021. What the hell are you guys thinking?
It was definitely a scary time. I think given both of our tenures in the industry and experience, we just felt that it was time to start working for not somebody else, but for ourselves.
Yeah.
We just had to make the move.
Yeah.
Very cool.
Exactly.
Very cool. Well, so every business starts with a mission. You got to have your mission statement, kind of your target customer. So I think they call that your avatar. Tell us about your avatar for Convoy. Sorry.
Yeah, all good. We are our specialty and our focus is in investment real estate for a lot of our higher net worth investor clients, and also new investors, and also kind of in luxury real estate as well. So we're kind of building our nest there, if you will, and making sure that a lot of investors are kind of under appreciated in the market, especially in the mortgage industry, where Fannie Mae and Freddie Mac continuously hit investors for having investment properties and for investing. So we wanted to change that. So we made sure to make relationships with different lenders and kind of build a bridge between the gap for investors and then also the lenders to make sure that investors get the best programs on the market without having to sacrifice, obviously, tax benefits and whatnot.
All right. Very cool. Well, why don't we give them an example? Give them an example of a program for investors oriented. I think we talked originally about a 40-year IO. Do I remember that right?
Yeah, exactly. Dustin.
No, that's correct. So, with the amount of time we've been in the industry, it's always been, and I don't want to, in terms of make it sound like I'm not up for a difficult job here. Let me just exit that out.
It's all right.
Okay. Sorry about that.
So
in the past, and you can ask anybody that's bought an investment property, you would have to provide tax returns, profit and loss, balance sheets, real estate owned, audited CPA letters, your son's blood, everything under the sun. And
right.
in terms of getting qualified for an investment property, they just made it, and Fannie Mae made it so hard to qualify. When in reality, our opinion is that it's similar to more of a commercial approach, common sense kind of lending. Because when you're buying an investment property, the property itself is the one that's going to be making the payment.
Right.
You care about that property. If the client forecloses, can the property pay the payment? On a primary residence, we get it. You're going to have to provide tax returns, W-2s, pay stubs, et cetera, because that homeowner is the one's paying it. There's no income coming off that primary residence. So we've made relationships with a lot of different investors and lenders that essentially require no income, no tax returns, no 1099s, no W-2s, et cetera. We're going to look at the property itself. The property is a good investment and it can kind of cash flow positively, and it's kind of crazy. It doesn't even have to cash flow positively, and we can still get you the keys. Okay. We'll be able to get you a loan that is very favorable, if not better than what you could get if you go with Fannie Mae and provide tax returns. Okay. This is pretty new on the market. I want to say it was really rolled out at like the end of 2020 and kind of went hand in hand, and why we started at the beginning of 2021 when we saw this opportunity. But one of the unique products that you can get with these investor programs that I just went over is a 40-year interest only. Now it's a little misleading. It's not interest only for the entire 40 years.
Sure.
It's interest only for the first 10 years.
Mm-hmm.
And after that, it's followed by your regular, I'll call it boring 30-year fix, if you will.
Okay.
So what it allows for is for the investors, especially if you're a first-time investor, to really cash flow positively in those first 10 years. You know, you're still holding on to the property, still retaining the equity and the appreciation that it's getting. But that cash flow, month-on-month cash flow that you're able to get in those first 10 years is obviously much more increased. And I'd say probably what 90% of our clients on investment properties are taking advantage of that.
So let me just, I love this, but let me just kind of repeat back what I think I heard and you tell me where I'm right or wrong. Cool?
Yep.
Sounds good. So I want to buy $1 million property, whatever it is, investment, whatever, the unit count doesn't matter. Or let's say I want to borrow $1 million. That makes it easier, right?
Okay.
So I'm borrowing $1 million. So for the first 10 years, I'm going to pay some fixed interest only payment.
That's correct.
Then 10 years from today, which would be February 3rd, 2032, a 30-year AM takes over.
Correct.
So far, that's kind of what I heard. Now the question's coming. Does the rate change, right? Whatever interest only rate I was paying today, I'm going to say 5%. We'll talk about that next. Does it reset in 10 years to the prevailing rate, or am I locked in at 5% interest from 2022? What happens?
It's the fixed part comes in there. So it's the same rate the entire way. So the only thing
I want to say that again, all 40 years,
the
rate does. So you could lock me in on an investment property for 40 years at, we'll get to the rate next, but I want to make sure I heard that right.
Correct. So it's fixed for
That's bananas.
So the only thing that changes on year 11 is principal kicks in.
Yeah, payment, what would that be? Payment 121, your 121st payment.
Is the principal, that's it. Rate stays the same, term stays the same, nothing changes.
That is nuts, because you've had 10 years of inflation.
Exactly.
In rents, right? Taxes up a little bit, insurance up, but you've had 10 years of inflation. That's bananas.
Yep.
All right, so now the $1 million question. Prevailing rates today, I don't know, we'll call them 4.25% for investors. I'm guessing this is higher, probably. I'm going to just wild ass guess it here, high fives.
So here's the kicker is because we have such an expansive product base and a list of lenders that we've built such a great relationship with. The floor rate right now, as of February 3rd, 2022, is actually 3.625.
Shut up.
Is the lowest rate we can get to. And obviously it'll be with points and whatever, but it's the lowest rate, which you're locked in for 40 years. So a lot of our clients are taking the lowest rate possible because it doesn't make sense not to, right? You're fixed for 40 years. You're hedged against rate increases or anything. But that's the floor rate. And kind of where a lot of our clients want to be. And
so this is going to be fun. So floor rate means, a lot of skin in the game, right? Good down payment. Probably decent credit, get you a little lower, gonna pay points. How many points am I buying to get down to that crazy? That's a ridiculous floor rate.
Exactly.
I mean, it can be, you fit in the right bucket. For example, I'll just give you a quick scenario. Let's say 25% down, not even that crazy.
Oh yeah, that's not bad. I expected more. Okay.
Yeah, on a purchase 2-unit property, you're probably paying 1 point to get to 3.6, so nothing crazy.
Oh wow, I expected 2.5 or 3. Okay.
Yeah.
All right. So I already know there's a lot of viewers right now that are going to be wanting to reach out. So let's just get it out of the way. How do you want them to reach out?
I think what would be best, you can go to our website as well at convoyhomeloans.com. I'm sure you can provide a link for us at the bottom.
Sure.
Or you can email both John and I. It goes to the same email. It's privateclient@convoyhomeloans.com.
Privateclient@convoyhomes.com.
Convoy Home Loans.
Oh, home loans. Thank you. See, that's why I asked. Homeloans.com. Very cool. All right. So 40-year IO. So let's just round it to 4%, right? Yeah. That's still. So again, I bring you again. It could be a duplex. It doesn't even have to be commercial, right?
Anything 1 to 4.
Yeah.
Oh, it's only 1 to 4. Okay. See, I'm glad I asked. So 1 to 4 unit. is there a floor on loan amount? Like, hey, we don't do loans under 100 grand?
It's technically depending on the lender, but the majority of our lenders say 150 is the
Okay,
minimum.
that's fine. That's
Yeah.
a fourplex. That's
Yep.
good.
Yeah.
All right, I'm trying to think of anything else that that might be out there. Are you you're gonna impound probably taxes, insurance, all that stuff?
You don't have to.
Yeah.
Oh
If
wow,
you want to, you don't have to.
wow.
Yeah.
This is crazy. Okay, this is amazing. So again, 4% for 40 years. I can have a 4% loan on a duplex for 40 years.
That's
Yep.
right.
And this is in the same time, I'm sure your viewers have also seen it and you've seen it in the news, but Fannie Mae and Freddie Mac for non-owner occupied homes, they're rolling out these new adjustments that they tried previously, and now they're gonna roll it back out.
Yep.
You know, it's already taking hit, right? How high balance loans, non-owner occupied homes, they don't want them basically.
No, they don't. They whacked them. I forget what the numbers were. They wanted to get them to like 12%. And they're running at 17 or something like that. Yeah, they're it's not quite as bad as 2010, where investors were like, don't come here, we don't want you. But it's starting to feel like that. They're like, yeah. So,
which is funny because you know, the backing of a lot of these programs, the 40-year IO program and cash flow program that we're talking about, you know, they're big institutional banks that are, you know, buying these loans. So it's not like they're subprime mortgages that are not backed and, you know, kind of traded weirdly. It's not like that at all. It's, you know, big backers like, you know, Goldman and all these people that are institutional, they're buying these loans and they're actually performing better than, you know, normal conventional FHA VA loans. Because the idea again is, if you have an investment property, you buy it to cash flow. You don't buy it to lose money on it, right? So that's kind of, you know, the main focus and why it makes so much sense for investors at this day and age to kind of take advantage of a program like this.
wow.
Yeah.
So obviously the Fed is raising rates, or at least they've talked like they're going to. We've seen investment loans, the kind of traditional 1 through 10s, already ratchet up. We've seen other non-QM lenders raise their floor rates, if you will. It has to happen, right? If rates go up, again, it has to happen, right? The floor rate won't always be whatever it was, 3.62, again, if the Fed raises.
Correct. Now, I personally believe in, you know, you probably have seen this song and dance a bunch of times now.
Oh yeah.
What's nice is obviously a lot of lenders get ahead of what the feds are going to do. And those are baked into the rate sheets right now.
Sure.
Or the March increase, of course. But of course, what you said is 100% correct. You know, that's why we're seeing such a high influx of you know, applications, because everybody knows, I mean, it's on the news every single day.
No, right, exactly.
And there's no end in sight unless, knock on wood, we have, you know, another global pandemic hit.
Yeah, no. Yeah. So is this, I guess one thing I didn't ask, is this only for purchase, or could we do a refi, cash out refi? Is this only purchase, or?
All of it.
Yep.
Purchase, refi, cash out, rate and term, everything. You know, we have clients, a lot of our clients right now, like, to put it into perspective, you know, a lot of them are like, they might be private client with like Bank of America or Chase. Even they are refinancing out of the loans that they just got into.
Yeah, of course.
To lock into a 40-year fix, just because the cash flow is just so ridiculous.
Yeah. So again, this is residential. So if somebody had an apartment building, can't play.
That's not necessarily, we can go up to 29 units, but we can have that conversation with that.
Okay. So that's good to know. 29 units. Okay.
Yeah.
I've heard 4, I've heard 13, 29 seems like a really odd number to pick. Is there any rhyme or reason?
That was just kind of the back and forth ping pong game we played with some of our investors.
Okay. All right. Well, there you go. All right.
29.
29. Okay. So not 30, but 29.
Yeah.
That's good. Okay. All right. And then you also talked earlier in your intro about luxury real estate. So define that, is that a price point, a zip code? What is luxury real estate?
I'd say so. Yeah. It's always been hard because we're mortgage brokers, of course, right?
Sure.
You know, we have over 100 different lenders and programs that we have access to, but a lot of the times brokers are kind of, in a way, at a disadvantage to the big retail banks, you know, Wells Fargo, Bank of America, et cetera. But the proponents that we've been able to figure out that can make us competitive is how we're able to get luxury real estate financing done for the client that doesn't have $10 million parked at Wells Fargo.
Mm.
We have a little bit easier restrictions on loan to value, debt to income, income qualifications using bank statements or assets that you can't go to Wells Fargo and get that job done. So we found a little niche there. We've done a couple just in the past month that we're pretty proud of, that you can find on our review pages and Instagram and stuff like that if you want to check it out.
Very cool. So what else, right? Again, one rental at a time obviously is oriented to people buying investment properties. We are doing some house hacking and whatnot, so all good. What else? What else you want to tease folks with? Because again, 40 years, 10 years of IO fixed for 40s, bananas. So that's going to be very cool. What else you want to talk about?
There was, you know what? It's kind of a coincidence. I spoke with, you know, we speak with clients, how many clients a day, I don't know, to be honest with you, but I had a pretty good conversation with a pretty high net worth client yesterday about this interest only product. And he brought up the point that anybody that's telling me no on an interest only product doesn't know what they're doing. Because I can make the argument, and I backed it with him, that making a payment towards the principal on your mortgage, if you're an investor, okay, it's a different scenario if you want to retire and pay your single family home off, right?
Yeah, very
but
different.
If you're an investor, let's just give an example. You know, over 10 years, let's say you're going to pay $100,000 towards the principal.
Okay.
Over 10 years.
Yeah.
And you're planning to sell the home, your investment property, in 10 years.
Okay.
All you're going to get back, if you decided to go with a 30-year fix instead of a 40-year interest only, is an extra $100,000 when you sell the home in 10 years, right? I don't need to tell anybody here that's watching the show that $100,000 now is worth a lot more than $100,000 in 10 years.
Yeah. No. Yeah.
So what you can do over that 10-year period with $100,000 for these investors, what, buy 2 or 3 more properties?
Yeah, or just pick up a dog, right? You're gonna have, you're gonna have 3 or 4 bad years. I mean, one of the things that's probably coming, in my opinion, is there's a lot of frustrated landlords, older landlords that maybe haven't done a lot of rent increases and take care of the property in the last 5 or 6 years. A lot of those are heavy lifts. If you could get IO periods, even for 5 years, let alone 10, where you could sort of get through the transition, because I've done it before, you're going to have at least 2 transitions. You never go from what you have to where you got with tenants. There's this middle jump. It's heavy. So having that time where, I don't know what it is, an extra percentages that you can keep because you're not paying principal, it's helpful. It all helps in the beginning. It all helps. And
then the beauty of the program too, we've kind of come to a negotiation period with the lenders and investors that we have. Some of them will allow for, if you really wanted to pay principal in the 10-year period, you can pay up to 20% of the principal balance on an annual basis without triggering any prepayment penalties. Yeah. So in a sense, it's like you're getting the best of both worlds. Not a lot of people are going to pay 20% of the principal on an annual basis, right? So, but it allows them kind of like, if they really want something, at the end of the year, they're like, hey, I have all this extra cash flow. Now I don't know what to do with it. I'd rather just put it back into the home. They can do that without any penalty, right? Okay. So that's also a kind of a little bonus that kind of plays into their flexibility and what they can really utilize the principal for that they've saved for X amount of period. Yeah, very, very cool. Well, I always like examples. Why don't you give an example? Obviously no names, just rough numbers of a couple of deals you've done. Maybe one in the luxury real estate you're proud of, and then one in this 40-year IO, just kind of, actually, you know what? I have one more question before we ask for examples. Can I buy a dog? Let's just say a rundown fourplex. It's pretty ugly. It needs $100,000, right? Of immediate investment. That kind of still qualify? Or you want pretty clean stuff?
It's going to be pretty clean. Yeah. You know, we obviously have the ability to get that client into some sort of either construction or loan, and then, you know,
makes total sense.
Exactly. Yeah. And then once it's ready to go, because remember, these loans are still backed by pretty big time investors and institutions. They're not going to. No, I just wanted to make sure. No, yeah. Again, that's why there are providers out there. Not all programs work for all products or all properties. Sometimes you've got to do the heavy lift, get it there, and then you get into the 40-year money. Makes total sense. But we have the program to be able to do that, right? So if you wanted to buy, a dog or so, then we can always bridge the gap,
finance the rehab costs, which we can, we have lenders that'll do that, finance everything. And then, down the line, we'll just refi into a rate and term and do a 40-year. Yeah.
There you go. I like it. Well, all right, let's close with a couple of examples. Floor is yours. What do you want to tell us? Some examples.
Perfect. I guess we'll start with luxury. I mean, we had a really nice one.
Okay. Yeah. So pretty unique. We just did one in kind of the Beverly Hills area in Los Angeles. It was for a primary residence.
Okay.
It was a 14 mil, it's 14-1, we'll call it, but it was $14 million luxury high-end.
Yeah, I would call that luxury no matter where you're at. There's not, you make it 8 digits, I'm going to call that luxury. You got it. Check.
Yeah. But it was a very unique situation. It only required 10% down in a cash 10% down. And how we were able to, we use a relationship-based loan, if you will, where essentially the client had some assets that he could pledge. Now, he didn't have to sell those assets or anything, but he, pledged them, right?
Yep.
So you didn't have to put your typical, 35, 45 down, because I tried bringing this loan to a retail, lender we have access to, and they're giving us, 35, 45 down.
Yeah.
That's a lot. That's a big check to write.
Yeah.
Yeah, so we were able, and there's a lot of other intricacies that I don't want to share too much
That's fine.
information from the client, but essentially, look, you can't get a 10% down loan on a $40 million property going to the big retail banks. So we got something out there
that's awesome.
And with less down, you know who to contact.
Yeah.
There you go. All right. Well, let's talk about a 40-year deal that you helped someone, because I got to imagine your phone's or email or whatever you want to call it's blowing up. Go and give me some of that 40-year money.
Yeah, I mean, we do about, I think, probably about 30 to 35 million in just this product on a monthly basis.
I'm sure.
So we have a lot of examples. I think, kind of a unique, we can even do unique properties. So like a unique example is like, we just did a condo hotel at the Pendry in Utah. They're making a new build. It's in Park City, Utah. Luxury condo hotel. Obviously that means that hotel and condo, right? And we did that on this same cash flow program. And it wasn't cash flowing, but we were able to get it closed on the premise of, hey, this is the cash flow to come. And we were able to close the loan, successfully, and kind of make sure the client has like a vacation home / rental property that's kind of managed by the hotel. And that was a very unique situation that, even those ones we can get done. But if we're talking about a classic 1 to 4, we do deals all the time where it's a purchase for like 2 or 3 million. They'll put 15% down, 15 to 20% down, and they'll get, the same 40-year IO fixed. The cash flow is, as long as it covers 100%, they're getting, basically the best pricing. And by that, I mean, the cash flow on the rents just has to cover, whether it's market or actual rents, has to cover the interest only payment plus taxes plus insurance plus association dues if there are any. Yeah. So it's not even, they're not even, hitting you for the full principal and interest payment. It's just the interest only payment. So that makes qualifying a lot easier. On the cash flow aspect. There's no, management fee deductions. There's no vacancy reserves that they're calculating. None of that. It is just a straight calculation of rents covering the actual payment. And, we do $2 million, $3 million, 15%, 20% down. And they're able to successfully grab these properties, even if they're vacant. So we do a lot of properties where, now kind of with moratorium, kind of being in that kind of limbo where people are actually moving out of it, people are moving into it, right? A lot of properties we're seeing are being delivered almost with a few vacant units.
Sure.
And with vacant units, retail lenders can't use the rental property income, right? But we're able to use on vacant units the market rents that are assigned to that unit. So by combining the vacant unit market rents along with the actual rents, which are, like you said earlier, a lot lower, right, than the actual market rents, by combining those together, we're able to successfully close these 2, 3 million, 3 to 4 unit properties, even duplexes, and have it cash flow well and have the loan work out in their favor at the lowest rate possible and at the lowest, everything possible.
Wow.
So that's a broad general
Sure.
example, but the reason I give that is because we do so many of those on a monthly basis. So
I'm sure,
the best way is to just umbrella it, into that scenario where, I'm sure you have a lot of viewers that'll fit, even, if it's not 2-3 million, that's fine.
Yeah.
But they'll still fit within the 150 to 5 million, 7.5 million range.
Yeah.
So,
absolutely.
yeah.
So I guess the last question to kind of close is that I'm just playing with all the different viewers I have on my channel. I'm gonna guess these are single loan, single asset type loans versus kind of portfolio or blanket loans. Like you're not going to go to Ohio and buy 7 little cheap houses and put it all together in one loan, I'm guessing.
Correct. I mean, we have the ability to do that, but you're not going to get the 40-year fixed IO on a blanket.
No, yeah, it's a different product again, right? Find the right product, the right area. So again, who's your avatar, right? It's the real estate investor, kind of one rental at a time, folks, I'm guessing.
Yeah,
that would be correct.
Yep.
Very cool. Well, how do you want them to reach out? We gave it to them in the beginning. How do you want them to reach out?
So they can email private client at convoyhomeloans.com. Or if they just go on our website, there's you can hit apply now and it'll have a whole thing they can fill out, and then it'll shoot their information over to us, and either Dustin or myself, especially for your viewers, will personally reach out to make sure that they get the VIP treatment.
Very cool. Is there like a little link there where they can say they came from one reel at a time, or like how'd you hear of us or something like that?
Yeah, we can make that possible.
Let's see how many one rental at a time fans reach out. So hey, Dustin, Jonathan, thank you very much for doing this. I had a great time. Look forward to your email or phones blown up. It should be fun.
I appreciate it. Thanks, Mike.
All right, guys.
Have a good day.
Yep.